In deals, the most expensive word is sometimes the simplest one: no. In 2008, Yahoo said no to a massive check, and then said no again when there was still time to close. What followed wasn't an overnight collapse. It was a slow, structural failure driven by incentives, valuation pride, and the fear of admitting that the game had changed. Let's go to the moment when the money was on the table. On February 1st, 2008, Microsoft publicly announced a proposal to acquire Yahoo for $31 per share, an equity value of approximately $44.6 billion. It was a cash and stock offer with a simple message. Together, the companies could compete more effectively in search and online advertising. 10 days later, on February 11th, Yahoo's board responded by saying the proposal substantially undervalues the company. In other words, our value is higher than this. And here's the business question. When a board says an offer undervalues the company, what exactly is it protecting? Intrinsic value, or the narrative that supports the price? Because valuation isn't just a number. It's power, reputation, and the accumulated weight of past decisions no one wants to admit were wrong. In 2008, accepting the offer wasn't just about taking the money. It was about admitting Yahoo needed a new engine, and that this engine wouldn't be built alone. Microsoft, for its part, framed the bid as hard to ignore. In public statements, the company highlighted that $31 per share represented a 62% premium over Yahoo's closing price on January 31st, 2008, the last trading day before the announcement. The message was clear. This was already above the market. When you reject a public premium of that size, you create an expectation, and the market starts demanding proof. Negotiations dragged on for weeks under intense public pressure and private back-channel talks. And then came the second no. In early May, Microsoft announced it was withdrawing its offer. Reporting at the time indicated Microsoft had sweetened the bid to around $33 per share, roughly $47.5 billion. But Yahoo still didn't accept. According to Reuters, Yahoo was seeking something closer to $37 per share. The window closed. Microsoft walked away. From an incentives perspective, both sides were being rational for themselves. For Yahoo, saying yes at the available price looked like an internal defeat. For Microsoft, paying significantly more looked like overpaying for an asset already under pressure. And this is how rational decisions produce catastrophic outcomes. Once Microsoft left the table, Yahoo didn't gain stability. It gained internal war. In May 2008, investor Carl Icahn launched a proxy fight to change Yahoo's board, arguing that management had acted irrationally by rejecting the higher bid. The no didn't just kill the deal, it detonated governance. And when governance collapses, focus shifts. Companies stop thinking about product and start thinking about defense. And defense doesn't create a future, it only buys time. In that context, Yahoo looked for alternatives. In June 2008, Yahoo and Google announced an advertising agreement under which Google ads would appear on certain Yahoo search properties in the United States and Canada. But the deal quickly drew regulatory scrutiny. In November 2008, the U.S. Department of Justice informed the companies it would file an antitrust lawsuit to block implementation. The agreement was abandoned. And then comes the comparison that defines the story. In July 2016, Verizon announced a deal to acquire Yahoo's core business for $4.83 billion. In 2017, after disclosures of massive data breaches, the price was renegotiated to $4.48 billion, and the acquisition closed on those terms. One important detail, in the 2016 announcement, Verizon made clear it was buying Yahoo's main operating business. Stakes in Alibaba and Yahoo Japan were excluded from the transaction. So the factual arc is this. In 2008, a no to $44.6 billion, and years later, the sale of the core business for $4.83 billion. That's not a joke, it's a lesson. And the lesson isn't that Yahoo was stupid, it's more uncomfortable than that. Large companies rarely die from ignorance. They die because incentive structures make the right decision painful in the short term. You protect the present and sacrifice the future. If you enjoy business stories about power, incentives, strategy, and structural failure, subscribe. Because in the No series, the next episode proves that sometimes the most expensive no is the one that feels the safest.